Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Hey, Ben.
Good morning, Will. How are you?
I'm doing okay. I wore my Mizzou. I don't know if you can see it or not.
Yeah, it looks good.
And solidarity after Kansas won the national title yesterday.
So, yeah. No, great game. Great game. A lot of fun.
Yeah, it was a very good game. I'm kind of sad because I thought whoever won the Baylor North Carolina game was going to win the title this year. So, when North Carolina got that close, I was like, oh, look at that.
And they just about got there, and they gave Kansas pretty much all they could handle last night.
Yep. So anyway, looking at this week, what adjustments have we seen in prices compared to last week?
Yeah, so diving right into the markets real quick. Old crop corn for May was up 2 cents to $7.50. New crop corn for December up 35 cents to $6.99. That's largely due to that planting intentions report last week showing a lack of new crop corn acres, or at least less than what the market was anticipating. Old crop soybeans were down 62 cents to 16.02. New crop soybeans for November down 29 cents to 14.39. Looking at those different components for soybeans, soybean oil was relatively flat, just down a couple of tenths of a cent per pound. Soybean meal was the big hitter there, down $24 or nearly $24 per short ton. Old crop May wheat was down 47 cents to $10.10. And then that new crop July wheat contract down 41 cents to $10.10 as well.
But what kind of highlights did we see from last week?
Yeah, and I've got quite a few highlights this week, so it might take me a little bit to get through these, but probably heading off last week's report week for USDA's planting intention stocks was really the planting intentions report. USDA showed that U.S. farmers plan to plant 89.5 million acres of corn. That was roughly 2.5 million less than the trade had anticipated, and nearly 91 million acres of soybeans, which was roughly 2.2 million acres more than the trade had anticipated. So at least when you look at corn and soybeans, the trade had predicted the total pie pretty accurate, but had basically switched corn and soybeans. All wheat acres were also down about 500,000 acres. Again, the upper plains struggling to keep those wheat acres. On the grain stock side, we're used to large surprises in the grain stocks, and for the first time in several quarters, we had a pretty unsurprising grain stocks report. All of them pretty much came in line with trade expectations. Strangely, it was the soybean stocks that were probably the biggest surprise or the biggest shock to everybody, which is interesting because soybeans are the commodity we have the most information about. U.S. ethanol production was slightly down on the week. It was about 6,000 barrels per day less. However, that continues to remain at very strong levels, and looking forward, I expect it to remain there. New export sales last week were mixed. The feed grains were all lower, or at least at the low end of trade expectations and down from the previous week, but soybeans was up. Weekly grain export inspections for last week were in line with trade expectations, but lower for those feed grains again, and then higher for the oil seeds. Managed money was down for all three commodities, corn, soybeans, and wheat future contracts last week. And then USDA's first crop conditions report of the season came out Monday afternoon. The biggest interest in that report was the wheat conditions ratings, which came in at 30% good to excellent, which was down 23% from last year at this time. And 36% was either rated poor or very poor here in the United States. So sorry, Will, that was a lot, but certainly a lot of action last week to get caught up on.
Oh, for sure. Yeah. So looking, on today's topic, we're going to talk a lot about trade, and we've been in a unique spot where maybe trade's been somewhat slow to actually come into an inspection, but it's still been a soft positive for the market. So what kind of situation do you see between corn, wheat, and soybeans right now within the trade market?
Yeah, great question. So there's kind of two different trade markets I look at. The first one is how much we're actually selling. Those are the physical sales, or the sales that countries intend to buy from the United States or commit to buy from the United States. When we look at the different components, corn is currently above the seasonal pace to hit USDA's target by 4%. Soybeans are above that seasonal pace 7%. However, we see differences in the components. So soybean meal down 2% from where we need to be, and oil up 20% from where we typically would see this to hit USDA's target. So USDA might need to increase that oil estimate in their upcoming USDA reports. Although the expectation is that we're going to use a lot of oil here in the United States as well. So oil certainly has had a very strong exports season to it. Milo or grain sorghum up 16% from where we would like to see it or expect to see it to hit USDA's target, and then all wheat down 6%. And that's probably not surprising to this point, because I remind folks that we had a very short spring wheat crop last year. And so with that lower production number, it's translating into lower wheat exports as we look ahead. So on the sales side, still robust. We hadn't seen major sales of corn, especially to the Chinese market up to date. Certainly last spring, they bought records amounts of corn and ethanol. If you remember back in that April-May period, those largely stayed on the books all through the year. They didn't take all of it last marketing year. It rolled to this marketing year. They've been working those stocks down a little bit. But yesterday morning, we saw a relatively large flash sale of corn to China, about 42.6 million bushels for the current marketing year, and then another 26.6 million bushels for next year. So excuse me, total 42.6 million bushels between the two sales, 26.6 million for the current year, and then 16.1 million bushels for the next year. Sorry, Will, I got off the line and I apologize about that.
No, when you're giving those numbers, I'm like, holy cow, that's bigger than I thought, and I misreported.
No, that was my fault. I was looking at the things. The point I do want to make here after my mistake, the point I do want to make is, I kind of look at this and ask myself, is this the start of Chinese buying of feed grain? Certainly we saw very strong purchases last spring. As I mentioned, they really didn't take shipments of those last year. They kind of stayed on the books and worked them down throughout the year. Mm-hmm. But our expectation is that China needs feed grains. And so is this the start? Is this large purchase the start of more large purchases to come?
Well, and that seems to be the general trend that's been talked about over the last couple of years or few years at this point. We've been focusing on things like African swine fever in China and them rebuilding their hog herd, and not just rebuilding the hog herd, but the infrastructure around it and getting better quality feed and things like that. So looking at that, the trade has been down compared to last year on the corn front. So do you expect that to pick up much here on out, or what are your expectations?
Yeah, good question. So let me step back a little bit and explain why they didn't take shipments of the corn, or at least all the corn that China committed to buy from the United States last year. They largely took shipments of U.S. corn until the Black Sea market came back online, until Ukraine and Russia came back into the picture and had corn to actually export. That's when we saw China kind of leave the U.S. market and go to the Black Sea region. This year, they weren't making large purchases to date. Certainly, as you mentioned, trade had been down. But now that we've got this challenge in the Black Sea region, it's kind of taken away that avenue for the Chinese. So I'm not surprised to see large purchases come on the books. That's kind of like an insurance policy saying, hey, we're concerned about the Black Sea region. The weather models in South America for that second crop Brazilian corn have turned dry. Let's go ahead and get an insurance product put in place to protect us in case corn prices just rally off the books. And so I think that's largely what China did. They took advantage of last week's breaks in price due to that acreage report and bought some corn. So I'm not surprised by that. The thing I don't know, Will, is how many more of these we're going to see. Mm-hmm. Certainly, I think for many analysts out there, the expectation is that we could see another 250 million bushels of corn come off the U.S. balance sheet to make up for what we're losing in the Black Sea region. To do that, we're going to have to start seeing sales in the next couple of weeks. And this has been my message as we go ahead, that the data to this point just hasn't signaled that we're going to see that. Does yesterday's announcement change that? It's possible. It's at least the first step. But as I always say, it takes 2 points to make a trend. So we need to see another one at some point.
So going back to something that you talked about earlier, both in your recap on prices and then on maybe some demand side issues too. So soybean meal specifically. So the price of that has been sharply lower over the last week. We're seeing concerns of COVID-related lockdowns in China. maybe that trickles into concerns of shutting down some soy crush facilities. So how does that impact soybean exports heading to China?
Well, so China has always prioritized their domestic crush industry. They've always wanted to take whole soybeans and run them through their crush facilities and make product. And I still believe that is their philosophy. I don't look for that to change. In the past, we've been curious about what Argentina export taxes do, given that Argentina is a large soybean meal exporter to the world, what those increased taxes would do for demand of meal and oil products out of the United States. And we have seen a little bit of blip. But I think the short version there is China just doesn't like buying components. They want to buy the whole soybeans. And I think that's going to continue regardless if there's facilities open to crush them due to COVID or not. They're not going to import much oil and meal.
What's the current wheat export outlook with ongoing issues between Russia and Ukraine? How much is that possibly boosting the U.S. value of the crop?
Yeah, that's a great question. So again, wheat's probably seen the biggest shakeups due to expectation that exports out of that region are going to be significantly curtailed. The market is kind of consolidated around that $10 range, at least right now, as we've kind of removed some of that early uncertainty. There's still a lot of uncertainty in the mix. But I think probably the biggest surprise to folks is just how much wheat is actually leaving the Black Sea region, what has already left from Ukraine. And then most of what's left to be exported out of the region is what's left in Russia, or at least the traditional Russian exports. And I expect that wheat to find its way in the global market. Some of those poor countries, and especially India, that imports wheat, I think we're going to continue to see exports of Russian wheat into those markets. So it'll continue to enter into the world market. Keep in mind that until we have wheat supply, our wheat exports are going to remain low. We just don't have a lot of exportable wheat here in the United States, and especially milling quality exportable wheat.
And then before we start wrapping up here, I want to get your thoughts on the first crop quality and progress report from USDA, notably on wheat. The quality is pretty bad. Obviously, we have a lot of drought conditions in the U.S. right now. Do you think that's going to move the market much, or do you think a lot of that was already factored in, so it might have slight adjustments to it, but nothing too extreme?
We'll see some adjustments. I don't think the market was anticipating quite as bad as what we saw out of the report. Again, 36% of the winter wheat crop was rated poor or very poor. I think that was a little bit of a surprise, even though we've been hearing in Kansas and Oklahoma, two of the three largest winter wheat producing states, so that their quality was not good. Kansas largely, I think, came in relatively where expectations were, but maybe it was Oklahoma that surprised people. Again, it's that drought out there that has continued to spread, especially as that wheat's coming out of dormancy. Not having adequate moisture, getting moisture to grow is becoming an issue.
All right, some good information there. Growers who want to keep watching the market, some reports to watch this week. Wednesday, we have trade data and the ethanol report, Thursday, export sales, and then Friday's going to be a big day. We have USDA's world supply and demand report coming out. So potentially a pretty big market mover there. So Ben, I appreciate your time. And as always, I'm Will Robinson on Brownfield.